Silver could hit $100 sooner than anyone expects. Here's why. Something is quietly breaking inside the global financial system. Not loudly. Not on the front page of Bloomberg. Not in the talking points of your financial advisor. But if you know where to look, in the data, in the flows, in the mechanics of a market that most people have never even studied, you can see it. Silver. A metal most investors ignore. A market most analysts underestimate. And right now, quietly, invisibly, it is setting up for what could be the most explosive repricing of any asset in this decade. The math is there. The supply data is there. The macro conditions are there. Most people just aren't paying attention. Stay with me for the next few minutes, because by the end of this video, you're going to understand something that the overwhelming majority of retail investors will never figure out until it's too late. We're going to walk through three things today. First, why silver is structurally different from every other commodity on Earth, and why that difference is about to matter enormously. Second, what's happening right now in the global macro environment that makes a $100 price target not just possible, but arguably conservative. And third, the specific triggers, the catalysts, the events that could compress what should be a slow, multi-year move into something that happens shockingly fast. Most investors look at silver and see a shiny rock. Smart money is starting to see something very different. Let's get into it. Chapter 1. The metal nobody takes seriously. Let's start with a question that sounds almost too simple. Why is silver so cheap? Right now, silver is trading at a fraction of gold's price. The gold to silver ratio, a measure of how many ounces of silver it takes to buy 1 ounce of gold, is sitting at historically elevated levels. Historically, that ratio has averaged somewhere around 50 to 1 over the long run. For much of modern history, it hovered even lower, closer to 16 to 1, which was actually the legal ratio embedded in the United States Coinage Act of 1792. Today, that ratio is far above those historical norms, which means one of two things is true. Either gold is overpriced, or silver is massively, structurally underpriced. And here's where it gets interesting, because when you actually dig into the fundamentals, the supply, the demand, the industrial consumption data, you start to realize that silver isn't cheap because it's unimportant. Silver is cheap because the market hasn't fully priced in what it's becoming. Here's what I mean. For most of financial history, silver was a monetary metal. People bought it and sold it the way they bought and sold gold, as a store of value, a hedge against inflation, a safe haven in uncertain times. That was its primary use case. But quietly, over the last 2 decades, something fundamental has changed. Silver has become indispensable. Not just useful, not just helpful, indispensable. Every single solar panel on Earth requires silver. It is a non-negotiable component of photovoltaic cells. Silver paste conducts the electricity that makes solar panels function. There is no viable substitute at scale. Every electric vehicle contains silver in the circuit boards, the battery management systems, the charging infrastructure. As EV penetration accelerates globally, silver demand accelerates with it. The data centers powering the artificial intelligence revolution, silver is embedded in the thermal management systems, the semiconductors, the connectors. Every AI chip manufactured requires silver. We are living through the most rapid electrification of the global economy in human history, and almost nobody is talking about what that means for the metal that makes electrification physically possible. The market is treating silver like it's still 1985. The fundamentals are screaming that we are in a completely different world. Chapter 2. The supply crisis nobody is reporting. Now here's where things start to get uncomfortable, because it's not just demand that's changing, it's supply too. And the supply side of the silver equation is, frankly, alarming. Let's talk about where silver actually comes from. Unlike gold, which is mined primarily as a primary product, meaning companies build mines specifically to extract gold, roughly 70 to 75% of all silver produced globally comes as a byproduct. It comes from lead mines, zinc mines, copper mines. Silver is extracted on the side. What does that mean in practice? It means that silver supply is not primarily controlled by silver prices. If silver doubles in price tomorrow, you cannot simply open new silver mines to flood the market with new supply. You would have to build entirely new base metal mining operations, which takes years, requires massive capital investment, and is subject to permitting, environmental review, geological risk, and geopolitical exposure. The supply response to higher silver prices is slow, limited, and structurally constrained in a way that almost no other commodity is. And right now, the data from the Silver Institute, the primary global authority on silver supply and demand statistics, shows something that should be causing much more alarm than it currently is. The silver market has been in a structural supply deficit. Year after year, demand for silver has been exceeding the amount of silver being mined and recycled. The gap is being filled by above-ground inventories, by stocks that were accumulated over previous decades. But those inventories are not infinite. They are being drawn down, and the deficit, rather than closing, appears to be widening as industrial demand accelerates. Think about what that means. We are consuming more silver than we are producing every year, and the primary demand drivers, solar, EVs, AI infrastructure, consumer electronics, are not slowing down. They are accelerating on a policy-mandated, globally coordinated scale. The energy transition is not a trend. It is a multi-decade, government-backed industrial program. Every major economy on Earth has committed to aggressive renewable energy targets. Every single one of those targets requires silver at scale. Now ask yourself a simple question. When a commodity is in structural deficit and the demand drivers are accelerating and the supply response is constrained, what historically happens to the price? You already know the answer. The question isn't whether silver reprices. The question is when and how fast. Chapter 3, the macro accelerant. But here's the thing about silver that makes the current moment uniquely dangerous, or uniquely powerful, depending on which side of this trade you're on. Silver is not just an industrial metal, it is also a monetary metal. And right now, the monetary environment is shifting in ways that could supercharge everything we've already discussed. Let's talk about the Federal Reserve. For the past several years, the Fed has been running one of the most aggressive monetary policy campaigns in modern history. First cutting rates to zero, flooding the system with liquidity, then pivoting to one of the most rapid rate hike cycles ever recorded in an attempt to contain the inflation that their own policy had helped create. And it worked. Sort of. Inflation came down from its peak. The economy didn't collapse into recession, at least not visibly. But here's what the official narrative glosses over. The United States is carrying a level of debt that is, in historical terms, extraordinary. Total federal debt has surpassed $35 trillion. The annual interest cost alone on that debt, the amount the U.S. government pays every year simply to service existing borrowings, has exploded to levels that are straining the federal budget in ways that haven't been seen since World War II. And here's the paradox the Federal Reserve faces. To keep inflation contained, they need to keep interest rates high. But high interest rates mean high debt servicing costs, which puts enormous pressure on the federal budget, which risks a debt spiral that forces even more money printing. And if they cut rates to relieve that pressure, inflation risks reigniting. The dollar weakens, real yields fall, and historically, when real yields fall, when the return you earn on cash and government bonds fails to keep pace with inflation, investors move into hard assets, gold and silver. This is not a fringe theory. This is exactly what happened in the 1970s. It is exactly what happened in the 2000s. And the macro conditions today rhyme with both of those periods in ways that are difficult to ignore. There's another layer to this, the de-dollarization story. The gradual, contested, but undeniable shift by a growing number of countries, China, Russia, India, the Gulf states, large parts of the global south, away from exclusive reliance on the US dollar as the world's reserve currency. This is not a conspiracy theory. The BRICS nations have explicitly discussed alternatives to the dollar settlement system. Central banks globally have been buying gold at record rates. The implicit message from multiple major economies is that they want monetary diversification. They want assets outside the dollar system. Gold benefits from this trend, obviously, and directly. Silver benefits because it is gold's shadow. Wherever gold goes in a monetary panic or a dollar confidence crisis, silver historically follows. And historically, silver's percentage moves dwarf gold's. When gold moved from $250 to $1,900 between 2001 and 2011, silver moved from $4 to $50. That's not a coincidence. That's a pattern. Chapter 4. The COMEX tension. Now I want to talk about something that most retail investors have never heard of, but that sophisticated market watchers have been quietly monitoring with growing intensity. The COMEX. The commodity exchange in New York is the primary global futures market for silver. It's where the paper price of silver is effectively set on a daily basis. Banks, hedge funds, institutional traders, they buy and sell silver futures contracts on the COMEX in enormous volumes, far larger than the physical silver market itself. And here is the tension that has been building for years. The COMEX trades paper silver, contracts, promises to deliver silver at a future date. The vast majority of those contracts are never settled with physical metal. They're rolled forward, or cash settled, or simply closed out before delivery is required. For a long time, this worked fine. The paper price and the physical price tracked closely enough that nobody worried too much about the gap. But something has been changing. Demand for physical silver delivery has been increasing. The inventories held in COMEX warehouses, the registered silver available for delivery, have come under periodic pressure. There have been moments, particularly in early 2021, during the Reddit-driven silver squeeze, where the spread between paper prices and physical premiums blew out dramatically. Physical silver dealers were charging premiums of 30, 40, even 50% above the COMEX spot price. You couldn't buy physical silver at anything close to the published market price. That gap closed, the crisis passed, but the underlying tension did not go away. Because the fundamental question that the COMEX structure raises is this: what happens if a sufficient number of large buyers decide they want actual physical delivery? What happens if the gap between paper promises and physical reality becomes impossible to paper over? History offers some uncomfortable answers. The Hunt brothers' silver squeeze in 1980 was ultimately broken by regulatory intervention. The COMEX changed the rules. But before it was stopped, silver ran from roughly $6 to $50 in under 2 years. Nobody is predicting a repeat of 1980. But the structural tension between a paper market and a physically constrained commodity is real, documented, and growing. And it is one more reason why the upside scenario for silver is not as far-fetched as most mainstream analysts would have you believe. Chapter 5. The Path to $100. So let's actually do the math. Let's talk about what a $100 silver price would actually require. First, let's establish a baseline. As of this recording, silver is trading in a range that represents a significant discount to many analysts' fair value estimates based on supply-demand fundamentals alone, before you even factor in the monetary premium. Getting to $100 silver does not require a financial apocalypse. It does not require hyperinflation or the collapse of the dollar. It requires a confluence of conditions that are, individually, already present or already in motion. Condition 1. Continued structural supply deficits. This is already happening. If industrial demand continues its trajectory and supply remains constrained, the fundamental price pressure is upward regardless of what the Fed does. Condition 2. A Fed pivot or a loss of confidence in the rate environment. If the Federal Reserve is forced by recession risk, by debt sustainability concerns, by political pressure to cut rates meaningfully, real yields fall, hard assets reprice. Silver benefits both as an industrial commodity and as a monetary hedge. Condition 3. A deterioration in dollar confidence. This doesn't require the dollar to collapse. It requires the marginal global investor to incrementally diversify away from dollar-denominated assets. Central banks are already doing this. If that trend accelerates, and there are structural reasons to believe it will, silver benefits. Condition 4. A COMEX stress event. This is the wild card. It doesn't need to happen, but if physical delivery demand spikes at a moment when registered inventories are thin, the repricing could be sharp, sudden, and dramatic, in a way that catches most investors completely off guard. None of these conditions is guaranteed. None of this is financial advice. But what I want you to understand is that the scenario where silver reaches $100 is not a scenario that requires fantasy. It requires the continuation of trends that are already visible in the data today. And here's the urgency component that most people miss. Markets don't move gradually when they move. They consolidate, they build pressure, and then they release that pressure in explosive, uncomfortable, blink and you'll miss it moves that leave most investors either watching from the sidelines or chasing a price that is already run. The 2020 silver move from $12 to $30 happened in months. The 2010-2011 silver run from $18 to $49 happened in roughly a year. When silver moves, it moves fast. And when it moves fast, the window to position intelligently is much smaller than most people assume. Chapter 6. What smart money is actually doing. Here's something worth paying attention to. Central banks globally are buying gold at the fastest pace in decades. That is a documented public fact. The World Gold Council reports it quarterly. The numbers are not disputed. Central banks do not buy gold because they think gold is a quaint relic. They buy gold because gold is money, real money, outside the counterparty risk of any individual nation's currency. Now, central banks do not typically buy silver. Silver's market is smaller, its price volatility is higher, and the logistics of storing physical silver at scale are more complicated than gold. But the institutional investment community is a different story. There are analysts at major financial institutions quietly building out their commodity exposure. There are family offices and sovereign wealth funds that have begun treating silver as a strategic underweight, a position they need to correct. There are industrial corporations that are beginning to think seriously about forward purchasing silver inventory because they've looked at the supply projections for 2026, 2027, and 2028, and they don't like what they see. This is the part of the silver story that doesn't make headlines because it's slow, it's deliberate. It's happening in boardrooms and portfolio committees, not in trading room frenzy. But smart money positions early, before the narrative becomes consensus. By the time silver is on the front page of every financial publication, the price will have already moved. The investors who benefit most will be the ones who understood the thesis before the crowd arrived. Most investors look at silver's current price and see stability. What they should see is a compressed spring. Let me leave you with this. We are living through a simultaneous convergence of forces that historically have never pointed in the same direction at the same time. Industrial demand for silver is structurally accelerating, driven by the electrification of the global economy. Supply is structurally constrained in ways that cannot be quickly fixed, regardless of price. The monetary environment is increasingly hostile to paper assets and favorable to hard commodities. Global confidence in dollar-based financial architecture is slowly, unevenly, but measurably eroding. And the paper-silver market sits on top of a physical reality that is tighter than most participants realize. No one can tell you when the repricing happens. That's the honest answer. Markets can remain disconnected from fundamentals for longer than any rational observer expects. This has always been true. But here's the question I want you to sit with after this video ends. If even half of what the supply data and the macro environment are signaling is correct, if silver is even partially as mispriced as the fundamentals suggest, what does that mean for the investors who are paying attention right now? And what does it mean for the ones who aren't? The window between when something becomes obvious and when it becomes expensive is always shorter than people expect. Do your own research, think critically, but don't ignore what the data is telling you. Because sometimes the most important financial truths are hiding in plain sight, in a metal that most people consider too ordinary to take seriously. If this analysis gave you something to think about, consider sharing it with someone who needs to hear it. And if you want to go deeper on the mechanics of silver's supply deficit and what it means for the next 12 months, that video is coming very soon. Stay informed, stay ahead.